Anyway, so everybody this year has their quiz back? Good, all right, are all your quizzes back? I have a number there, but they might be people that are dropping or get dropped. Okay, you guys know that we have a holiday coming up. We really need it. Actually, next time we're halfway through the semester. How about that, Wednesday? And we're, what, a quarter of the way through the points? Something like that? Right? That's about where we're at. Pretty good, too. Okay, so that's about right. We have a review session next time. It's in room 214. Is that the last one in 214? Or there's one after that, isn't there? The one on the 14th is also in there. And then from then on, we'll get to have this room. Okay, so downstairs, room 214. Make it if you can. And I have down here that's from 2 to 3. Does that sound right? So anyway, next time we're going to finish up, well, we're going to talk some more about property, plant, and equipment. And then we're going to talk some more about liabilities. I'm not going to really talk about liabilities very much. It's going to be present values and future values. We've done liabilities before, haven't we? So pick up the new stuff in the chapter, right? You can discuss it probably. Okay? It just adds on to what you already know. Anyway, on Friday there's a quiz, isn't there? And then we have the fall break. And then what happens on Wednesday when we get back? Review for the test, and there's a review session then from, it says 2 to 4:30, is that all right? October 14th. And then that is the next one. And then there's a test on the 16th, which is a Friday. So over this fall break, what are you guys going to do? Study. You don't get a break until when? Christmas. Christmas, yeah. Well, I guess that's kind of when it really, yeah. It'll be Christmas, okay? It's like 3 or 4 weeks, right? And you only have to do your job or work to make money. Most of it, right? But at least you don't have school to worry about that. Okay? And you'll be working too. And athletes will be playing their sport. So frantically. That's probably what the fall holidays were too.
I can do the last one.
What's that?
You start right after.
Start right after it. Oh, that's your last break. Okay, you actually do get a break. Okay, that's kind of nice. Before everything breaks loose. And then chapter 10, right after the test, bonds, uses all this present value stuff we're doing. Okay, really heavily. So I already told you that the present value, future value, we use it all the time for making business decisions. What happened to that? Went away. We use it all the time making business decisions, right? This is going to be the first one we use, okay? And you're going to think it's fairly complex. It's really pretty straightforward. But you're going to probably think it's pretty complex. That is strange. It's still there. Okay, anyway. All right. I don't think I've had that one happen before. Oh, anyway, do that questionnaire and tell them that you like having PowerPoint in classrooms, and, you know, if you like the YouTube, say you like having the ability to record stuff. Right? I think we'll have something anyway because they want to do online education, so you got to have something. But they don't necessarily have to put it in classrooms. Typically, what professors do is they sit at their desk or in their house and they talk into the little camera. Have you ever seen one of those things? Unbelievably boring. Unbelievable. Well, imagine if I'm just sitting there talking to myself, trying to figure out what to do. You know, it's kind of hard to put any personality into that. So I've had students tell me that they've looked at videos for Accounting 101. Have any of you guys done that? You know, the ones, there's all kinds of them out there, like on YouTube or wherever, right? You can go find them out on the internet. And I've had students say, oh, God. Because I thought, well, maybe I should use those instead of putting my own out there. And they said, oh, God, don't do that. You're bad enough, right? That's not anything worse than that. So, yeah, I get the message. So, anyway. What we were doing last time was depreciation, right? Let's do that first, and then we'll get into some present value, future value stuff, okay? A little bit. Okay, and then we'll continue it on the next time. I see you guys, and you'll have worked all kinds of present value, future value problems by then, right? And if you haven't read the chapter yet, get with it, okay? Get going. You have read the property, plant, and equipment chapter, right? Okay, now you should have the liability chapter read too, right? If you procrastinated over the weekend, get going. It's going to be right on top of it. This quiz is coming, right? Okay, so what do we want to do? We had a piece of equipment, didn't we? That cost us how much? I used different examples in 2 classes. What did ours cost? Was it $200,000? 200 even? And then we had a salvage value or residual value on that? 20. Which gave me a depreciable value, of course, of 180. I'm going to stop depreciating when I get down to what, guys? 20,000 remaining book values, right? When I get accumulated depreciation of 180. Everybody knows this. Okay, and then I think I had a 5-year life, did I?
think so, yeah.
All right. So and what we were doing was we were saying, well, if I wanted to use double declining balance, what does that mean? For double declining balance, it's 200% of what? 200% of the percentage you would have used for a straight line. It's not 200% of the depreciation, it's more than that. Okay? It's more than that. So don't just double the depreciation for straight line. That's a real common mistake. We're doubling the percentage we take, okay? What would the percentage have been with straight line for 5 years?
20%.
1/5 a year, which is 20%, okay? And I want to double it, so guess what? It's 40%. We did this last time, right? Okay? What if it's 150% declining balance? Well, it's 1.5 times 20, right? Big deal. Be 30%. Everybody got the idea of this? Just easy, isn't it? Okay, so we're going to do exactly the same thing we did with the other three methods, right? We're going to calculate for each year, year 1, 2, 3, 4, 5. We are going to calculate what? How much depreciation expense we have, debit depreciation expense, right? And how much we're going to increase accumulated depreciation. Everybody agree with that? That's always the journal entry. What's the journal entry for recording depreciation? Debit depreciation expense, credit accumulated depreciation, right? Always use the same accounts, of course, right? It's just going to be different amounts for the different methods. Everybody got the idea? It's easy. Okay, anyway, so what I want to know then, so I can get this entry, by the way, it seems like this is an awful lot of work to get numbers for the income statement and balance sheet. Remember, people invest their money based on this, right? To make decisions about what they're going to do with the business based on how the business is doing. This is really critical. I use little tiny numbers. It looks like 200 there. It could be 200 million, right? Okay, it could be in the billions. People are doing this. So you want to the extent possible, tell people the truth about what's happening, except you don't know what that is. You're estimating the truth, right? Okay, there's a lot of judgment involved in this, but you want to give them a reasonable estimate of what's happening here. Okay, anyway, so let's figure out what depreciation expense is, don't you think, for each of the years. And then that's obviously going to be the debit, the depreciation expense. And then we can figure out what accumulated depreciation is going to be because I'm going to add it up, right? Accumulated depreciation is just going to be the depreciation expense for all the years added up over time. And every year, what do you do to depreciation expense every year before you start the next one? Close it, make it zero, right? Okay, what do you do to accumulated depreciation? Nothing, you just accumulate it, right? Why? Depreciation expense is a nominal account, right? Temporary account. Income statement account. What's accumulated depreciation? It's a contra asset. That's a permanent account, right? We don't close it. We just accumulate it, don't we? You don't get rid of your accumulated depreciation because you start a new year. It'd be absurd, right? Okay, so here we go. That's going to allow us to get the book value, huh? What's the book value going to be? Well, we paid for the equipment at the beginning, less accumulated depreciation, right? So, let's go. How am I going to calculate that depreciation expense? It's 40% of what? The book value. But what's the book value at the beginning? If you bought an asset for $200,000, you have an equipment account with $200 in it, and you have accumulated depreciation with $0 in it, what's the book value? It's $200,000 at the beginning. At time 0, it's $200,000. Does everybody agree with that statement? It is, isn't it? Okay, so what's your depreciation going to be the first year? 200 times what? 0.4. How much is that? Is there anybody out there? Come on, you guys. Is that 80?
Yeah.
Okay, it's a lot of depreciation. Is that more than straight line was?
Yeah.
Straight line was 20% of 180, right? 5 divided into 180 is 36,000. This is 80. Huh? It's more than double, isn't it? Everybody see it? Debit depreciation expense for 80,000. Credit accumulated depreciation for 80,000. What do you have in accumulated depreciation if you started with nothing and you put 80 in there? 80,000. What will be your book value? Now be careful, it's not 180 less the 80, is it? What is it? It's 200 less the 80, right? Everybody get that? Okay, 120. What are we going to do the second year? The remaining book value, right? It's declining balance, right? Declining balance. So the balance is declining, right? It went down from 200 to 120. Okay? It's 40% of 120. How much is going to be the second year? 48. Debit depreciation expense, credit accumulated depreciation. Everybody agree on that? Okay, that's what it'd be, wouldn't it? So now what would you have in accumulated depreciation? 128. Okay, what's your remaining book value, of course? 200 less 128 is 72,000. Everybody got it? It's too easy to believe. Okay? Now what would we do? 72 times 0.4, right? 40% of the 72. How much is that for the third year? 20,800? 28,800. Okay, debit depreciation expense, credit accumulated depreciation, right? What do you have now in there?
156.
156. Whoops. Yeah, 128 plus 28, 156.
8,000, yeah. I mean, 800.
And the net book value of 43,200.
Ah. Now, what do we have to be careful of here, you guys, when we're using this method? We have to stop when we get to what? The salvage value, in this case, 20,000, right? Everybody got it? Okay. All right. How about year 4?
17. You have a depreciation expense of 17,280.
Okay. 43.2 times 40% is 17. What is it? 280.
280.
Debit. That's just 43.2 times our 40%, right, guys? Remaining balance times 40% every time. Okay. Good. All right. So debit depreciation expense, credit accumulated depreciation, right? What do you got now? 156.8 plus 17,280. What is it?
174,080.
Now we're getting close, aren't we? When do we want to stop depreciating? When we have 20 left. What do we have left for book value? 200 less 174,080 is what?
25,920.
Ta-da. Okay? Easy? Yeah, 200 less 174,080. Okay, that works? Everybody good on it? We got the math right? Okay, now what? What would you like to do? Take 40% of that. Can you take 40% of it? No, what's 40% of 25,920?
10,368.
10,368, and how much can we depreciate before we get down to 20?
5,920.
Yeah, so we'll stop at 5,920, of course, right? Debit depreciation expense, credit accumulated depreciation. What do you have now in accumulated depreciation? 174,080 plus 5,920 is how much? 180,000. It's a miracle. And what do we have left for remaining book value? 20,000. If you use it more over the future years, you still don't depreciate it, right? Unless we change the estimated life or change the salvage value. And we'll do that next time or in the review session. Okay? We'll mess with that. Got it? We'll work the problems that I suggest and you'll see it anyway. Okay? Are you guys getting so you can really learn working those problems? Many of you have never done that before in your lives, you know, actually learn something doing the problems instead of being taught it first and then do a problem and learn it, right? It is so much more efficient than somebody else telling you how to do it. I really hate going and listening to somebody talk. I do this for a living, and I would never go listen to somebody talk. I'd rather read it and know it. What do you think? We're wasting your time here. Well, not really, because the progression is, you know, when you're a kindergartner, you really need somebody to show you how. Calm you down to get you to stay in one place and do something, right? And then over time, more and more and more, it's on you. And ultimately, if you do a PhD, you're trying to create knowledge, you guys. You can't learn it from somebody else. Wow. But you read what everybody else did, right? So that you can do something else beyond that. That's kind of the idea, right? Kind of cool. It's really fun. So don't fight getting so that you can pick it up on your own. I think you could read this book cover to cover and you could read every single one of those problems and never meet me in your life and know what you're doing. I hope you get something out of knowing me, right? Really what I hope you get out of knowing me is that you work your ass off, right? You learn to do that. And, you know, wish there's something to learn. And that you get a general understanding of the theory behind it a little bit, maybe, and experience and all that kind of thing. Maybe you pull out of it. Yeah. So don't overstate. And then when you're in a position where you're teaching somebody else, don't make a big deal out of it, huh? So what you know and they don't. What's your job? If you're at work and you have a new employee and your job is to teach them how to do it, what do you want to do? Have them know it as soon as possible, right? Make them more valuable, which of course makes you more valuable, right? You did it, right? You get some of the credit for it, not much. Okay, anyway. So, here we are. Everybody, can you all do this? These depreciation methods are easy, aren't they? All right, let's add something else. Let's say, and we could do this no matter which method we're using. We can sell things, right? You don't have to keep the asset the whole time you can decide to sell it. Does that make sense? You know, I changed my plans. I'm going to sell it. So let's say it's the end of year 3, and I'm going to give you 3 different scenarios, and I'm selling it for cash, okay? So scenario 1, scenario 2, scenario 3, okay? 3 different ones, okay? Sell for, I don't know, $30,000. And we're going to make, when did I say it was at the end of year 3? So I decide not to keep it after all. Everybody got the idea?
Are these all for year 3?
Yeah, there's different scenarios.
Okay, cool.
It's or, right? So I sell for 30. Thank you for that. Or I sell for, I don't know, 50. Or I sell for 43,200. Could I sell it for different amounts of cash? That's cash, okay? Cash. They're all cash. Everybody got it? End of year 3. Sell for cash. By the way, I'm going to make a journal entry for this, right? What do I know I'm going to debit? Cash. Everybody agree with that?
Yeah.
No big deal. Of course you're going to debit cash. Okay? In fact, if I were doing these on a quiz or a test, I'd probably do that. How much are you going to debit cash for on the first one? 3,000. What are you going to debit cash for in the second one? 50,000. What are you going to debit cash for on the third one? 43,200. Everybody agree? Okay, I sort of gave it away by putting right that 43.2 down there. What is the remaining book value at the end of year 3 after you have depreciated it for 3 years? What's the remaining book value of this asset? 3 years? 43,200. What's on your books relating to this asset? On the balance sheet, what's on there? Because you close depreciation expense, right, to start the new year. Cumulative depreciation is on there. How much is it? 156.8. What else is on there? Well, depreciation expense is going to be closed, though. That's in your income statement. It'll be closed. What else is on the balance sheet? Oh, equipment. Yeah. The equipment's on your balance sheet at 200, right? If I get rid of this piece of equipment, what do you think I need to get rid of? How about the equipment? What else should I get rid of? If you get rid of the equipment, you got 200,000 of equipment that has depreciation of 156.8, so it's a 43,200 asset. Everybody agree with that? If you get rid of the depreciation, what would you have? A $200,000 asset with no depreciation. That's not true. What if you get rid of the equipment and not the depreciation? I guess you'd have 0 equipment and a credit balance of 156.8 and accumulated depreciation. You'd have a negative asset of 156.8. That's not true either. What do you have to get rid of? Both of them. That's it. That's the trick, you guys. That's all there is to it. So don't credit equipment for 43.2. That's not what happened. What happened, you guys? You got rid of all the equipment, didn't you? So what do you want to do on the first one?
Credit equipment for 200,000.
Credit equipment for 200,000. What do you want to do for all of them? I think you want to credit equipment for 200,000, don't you guys? Of course you do. You don't have the equipment anymore. What do you want to do for this one? Credit equipment for the 200,000. I don't need as much room here to see why in a minute. Okay, good. Big deal. What else do you need to get rid of if you got rid of the equipment? Accumulated depreciation. So let's get rid of it. What's the balance in the account?
156,800.
156.8. And of course, the difference between those two is the book value of the equipment, right? That's the 43.2. Everybody agree? Now, this is just not a big deal. And you know what I think? I think in one of these we have a gain. I think in one of them we have a loss. And I think in one of them we broke even. What do you guys think? What's the carrying value of this asset? Book value? 43.2. What did you sell it for 30,000? What happened to you?
Loss.
You have a loss. Everybody agree? How big is your loss?
17,200.
30,000 away from 43.2, right guys? Everybody agree with that? So I have a loss. Now a loss is like an expense, only it's different, right? You like that? I lied to you guys when I said there were only 5 kinds of accounts. You already know that, right? Really there were 10 because there are contra accounts on all of them. But this is kind of like, you know, when my wife asks me if she looks fat in a new dress, I don't even think about it. What do I say? Of course not, sweetheart. You look wonderful in everything. No. This is called survival, right? This is not lying. They're little white lies. It's fine. She doesn't want me to say, oh man, I think you put on 5 pounds with that dress. You better go to a different one. Right? You know, that's not going to do it. Right? So guys, if you don't know that yet, you want to know this. Yeah, okay, anyway. Yeah, survival. So that's not really a lie. So I didn't really lie to you when I said there were 5 kinds of accounts and there are really 12. I'm going to have 2 more right now. Right? It was, what if the first day if I said there were 12 accounts, that's all you have to learn? The 5 sounds better, doesn't it? And besides, they all work exactly the same, right? They are kind of the same. A loss is a lot like an expense, okay? Guess what kind of a balance it has in it? Debit. Because losses do what to your income? Reduce it. How do you reduce income? Either by increasing expenses or decreasing revenues or increasing loss, right? How do you reduce income? With debit. So it's still a debit. Got it? We just call them losses. Okay? There's also a gain. What do you think the gain would be here?
Credit.
A credit, you bet. Just like a revenue. Okay? And where would we have a gain, by the way? We have a loss on the first one. Where do you have a gain?
50,000.
On the second one, if you get 50,000, 30,000 would be a loss compared to 43.2. 50,000 would be a small gain, right? 6,800. Everybody agree? This is common sense. Let it be common sense. Don't memorize it, right? You guys gave that up a long time already. Right? It's just too much stuff. Right? It just makes sense, doesn't it? Common sense. Okay, anyway, a gain is like a revenue. But here's the deal. Gains do not have any expenses associated with them. They're just by themselves, okay? Revenues have, it's revenues less expenses as income, right guys? Gains are just all by themselves, okay? It's the gain. Losses have no revenues associated with it. You just have a loss. Now let's think about this. I like UPS, I guess, because UPS is here in town, and besides they come to my house every day, right? You know, and deliver stuff from Nordstrom's, pretty much. Yeah, anyway, so in other places, my grandkids, anyway, so where would we be without that? I'd like to live way out in the country. My wife says, oh, no, I have to be near stores. I mean, you don't go to stores. Everything's delivered. You could be in the middle of nowhere, right? Get stuff, I would think. Anyway, UPS. What do they do to earn revenues? They deliver product, right? They deliver packages, okay, right? Okay, so that's how they earn their revenues. All the expenses, costs associated with doing that are their expenses. These are their normal operations, right? Is what they're in business to do. Remember that operating income idea that we did in Chapter 5, revenues less expenses? And then we had non-operating stuff. What if UPS sells an airplane after they use it for a long time, they've been depreciating? Or a truck. They sell it, they've been depreciating. They'll have a gain or loss on that transaction, right? That's non-operating. They're only going to show the gain or loss on their financial statement. Got the idea? By the way, it depends what business you're in. How about if Ford sells a truck? That's revenues and expenses, not gains and losses, right? Because they sell trucks. What if Ford sells a building? That's gains and losses. How about if a construction company sells a building? That's revenues and expenses. What if a construction company sells a truck? That's a gain or loss. So what business are you in? I had a client when I was in Ellensburg, Washington. They were in Yakima, Washington. That is really nearby. Distances are long out there. It was over a 4,000-foot mountain pass, and it was 50 miles away. But it was the neighboring community, right? Not like here. It's amazing. Lots of open land. Nothing in between the two. It's out in the desert. Snow in the winter, hot in the summer. But anyway, I had this client that I worked on in Yakima, and they were in business doing gravel roads and relatively inexpensive county roads. You know, they're a paving company, right? So they do gravel roads and pave, paved roads. Anyway, and they thought that was their main line of business, but then what happened was every time that the economy would slow down a little bit, people would go broke that were in the road building business. And then when the economy would fire up again, there were lots of tax dollars to build roads, right? And a whole bunch of people would go into the business. And what they did was every time that there was a downturn in the economy, they wanted to keep all of their people working, all their mechanics working. So they'd buy used equipment from bankrupt companies. And then they'd fix it, right? Make the investment in fixing it, and they'd have a whole bunch of equipment. And then when the economy took off again, guess what they did? It was all like new, and they sold it, and they made a lot of money doing this. In fact, they were making more money on their gains on selling this equipment than they were making off of building roads. Because the government doesn't want to pay very much for the roads, right? So you had a real small profit margin. So I looked at it and I said, you know, really, you guys are in the equipment business. It's, oh, no, that's just so we can make it through the slowdown. And no, that's where most of the profit comes from. So we changed that to revenue and expenses too. They disagreed at first, but well, yeah, I guess we are in that business. And besides, the bank's going to look at this and say you're a much more profitable company on a continuing basis, and it looks like you are, right? In your operating income. And it really is operating income. It's what you're doing. So this can, my point is this can change if your business model changes, right? Okay? So anyway, what would we do with this entry? Let's do number 3 first. Oh, what about number 3? How much gain or loss do we have?
None.
None. We're done. I like to do number 3 first because we're done. Do the debits equal the credits? Of course they do, right? Okay, how about number 1? What do we need?
We have a loss of 30.
We have a loss. Is loss going to be a debit or credit, everybody?
Debit.
It's debit. Why? It's reducing income. So how much is the loss here? We call it loss on sale of equipment, okay?
13,200.
How do you get 13,200?
Add the accumulated depreciation plus the cash, and then subtract the addition of those two.
Well, you could do that. You could add this one plus this one less that one. That'll do it. What else do you have? 30,043 too, right? You lost 13.2. Does that make your journal entry balance when you debit 13.2 to a loss? Yes. Got it. Okay, let it be common sense. How about on the next one? You guys are sick of hearing me say that. Anyway, but it's true. How about on the next one here? If you sell it for 50,000 and it's the book value is 43.2, what happened to you? Gain. How much? Gain on sale. How much? 6,800. Ta-da. Journal entry balance? Yes. Got it? This is easy, isn't it? I'll actually give you points for this kind of stuff. I hope you're starting to figure out that Keith gives you points for all kinds of easy things, right? I really do, huh? If you know how to do it, it's easy. If you don't know how to do it, it is impossible. That's the way it works. Expertise.
So we literally record it as loss or gain.
That's it. And where does it go? Which financial statement do you want to put it on? No, gains and losses. Income statement. So I'll show all my revenues less my expenses is my operating income. And then in the non-operating section, remember from chapter 5?
Yeah.
In the non-operating section, I'll have my gains and losses.
Okay.
And other revenues and other expenses. That's going to hit the income statement. What's going to happen on the balance sheet is you're no longer going to have the asset and no longer have the accumulated depreciation. Got it? That's a great question. Thank you. Okay? Yes, sir.
The gains are taxable?
Oh, yeah, the gains are taxable. And the losses will reduce your tax if you're in a taxable position. Yes. Now, gains and losses might be taxed at a different tax rate, depending on what kind of equipment it is. So later, if you become an accounting major, are you an accounting major? Okay. When you do, okay, when you become an accounting major, you need to take a tax class, or even if you don't, if you want to take a tax class, obviously you can. If you take a tax class, we'll talk about those different types of equipment, right? And buildings and stuff, but how the different tax rates are different for different types of transactions. Yeah, but yes, it's taxable. Okay. Good. Goes on our income statement, part of our income. Yeah.
So does it matter how it's listed on the journal entries as far as loss comes first, or?
Oh no, any order. Just always put your debits together. This journal entry now has 4 lines, doesn't it?
Yeah.
Yeah. You can have as many as you want. Imagine if Exxon buys another oil company. How big the journal entry is. Thousands of lines, right? Yeah, so it doesn't matter. As long as the debits equal the credits, and by convention, we always show all the debits first and then the credits.
Right.
And there are still a couple of people, at least 1 or 2, between the 2 classes that are still putting them in a row down the page, and I'm giving them half the credit. Never do that, right?
Journal entry with the one.
You know, put the debits to the left and the credits to the right, and you got it made. Both the number and the account, so you can tell them apart. But, and if you don't have them, you know, if you have some debits after the credits, I'll live through it. Right? But yeah, you know, when you're rushing, and it might look as bad as mine by the time you're done. Some of them do. You guys have an excuse. You're under pressure. I'm just, I guess, lazy or something. I don't know. All right, good. So we all good with that? No big deal? So should we do some present value, future value stuff? Okay. It's going to seem like when I'm going through this that I'm insulting your intelligence because I'm going to make it so simple. But here's what I want for you. Okay? I want you to get this intuitively. So it's just part of you. You just understand. You're not cranking math out here, right? How many of you like math? You know, you're pretty good at it, you think, you know, but you like it and it's kind of fun and you just do it, you know. Yeah, a bunch of nerds. Okay, how many of you screw up everything you try to do when you use a formula like me? Right? Okay, we got some of those too? Okay, yeah, it's everybody else in between. Okay, here's the deal. For those of you that are like me and can't do math, you know, although I got pretty good at it. I mean, you know those GMATs and SAT, ACT stuff, that kind of stuff that you did? I was really good on verbal stuff, I guess just naturally. And then I was really crummy at the math stuff. So I'm an accountant, right? That's because you add, subtract, multiply, and divide with a calculator. Big deal. Even I can do that, right? But my brain just doesn't kind of work that way. I took a finance class once in my master's program at Pacific Coast University, and this guy had just graduated from Wharton School of Business at Penn State. It's an excellent business school. And so he'd just gotten his PhD, and he came in, and he'd walk into the room, and it'd be 3.5-hour class once a week, and he'd write formulas all over the board, and then he'd leave. And I'm looking at this, and I'm like, what is this? My mind doesn't work that way. So I went to his office, and I'm saying, well, could you explain this to me? And he wrote more formulas down, and then some more formulas down. And no. Can you explain it in English to me? And he's like, what? That's really inefficient. Why would anybody do that? It's so much faster. Yeah, I know, but I don't know what any of that stuff means. So then he could explain it to me in English, but it was very, very painful for him. I explain it in English and then I can finally get to the math stuff, you know? It doesn't matter how you get there. Not at all. For those of you that have trouble in math classes, here's a clue for you. When somebody writes something down, ask them what it is. You guys tell me, what does that mean, that mean, that mean, that mean, that mean, or that mean? Those are variables. What could they be?
Anything.
Virtually anything. Are you kidding? Yeah. So when somebody writes down a formula, what does it mean if you don't know what the variables mean?
Anything.
It means nothing. Yeah, it doesn't mean anything. It means nothing. It means something to the professor who wrote it down. Now, if you think about this, I think I'm probably pretty good. I'm not very good at very many things, but I'm pretty good at explaining what the notation means as I put the notation up. One I don't use very much, so I don't have to. But if you're in an econ or a stat class or a math class, it's all numbers, isn't it, guys? Right? And it's all formulas. What do you need to do if you don't know what the formula means? Get your hand in the air and say, what does that mean? The professor isn't really intentionally confusing you. They just have been using it so long that they know what it means. And they think everybody does. Like everybody knows what debit means, right? First time I taught, I thought I could just tell people debit means left and credit means right, and I could go on with my life. It doesn't work that way, does it? It takes you a while before you really believe, right? You really get it down. So what does this mean, you guys? Obviously, it's what? Present value. P stands for present, V stands for value. And what's a little o mean? Means time zero. Now. Means now. By the way, you can have a present value 10 years from now, put it 10 then. We won't worry about that in this class, but you could. Okay, be all right. What is good? 10 years from now, treat it as the present value then. Imagining you're out there. That's also future value 10 years from now. It's the same value. Oh man, that'll drive you crazy. Okay, let's not do that. Okay, but it's true. Okay, so that's what that means. So always ask, okay? So getting this intuitively, if I'm calculating the present value of something, it's how much it is worth now, right? So if I say I have $100 right now, what do you think $100 is worth right now if I have $100 right now? I think it's $100. Okay, all right. This was fun in the other class. First, I'll put this one up. What does that mean? A future value. That's an N, by the way, a little N. What does that mean?
Number of years.
Number of periods. Years, months, quarters, whatever it is, whatever your time period is. Number of periods. If you don't know that, it's over, right? Future value, a number of periods from now. That's it. We're going to really use this when we get to that bond chapter, the next chapter, right? Okay, we're going to really use this, so get it down. We're going to use it for everything throughout your careers. That's how we value everything. Okay, so future value is what that will grow to in the future, huh? Got it? Or I could know the future value and want to calculate the present value of it now. Okay? If I was going to give you $100 a year from now, we can figure out how much that's worth to you right now. Okay? It's different for different people, depending on who's giving it to you and who you are. Oh, that's because we are going to care about the interest rate. This is what was fun. I wrote down a little I like that, and everybody thought it was a C with an asterisk on top. I probably was more sloppy like this. So I went for a long time. Right after I just said, if you don't know what some notation is, you immediately get your hand up and ask. So we went about 20 minutes. Somebody sitting over here says, what does C with an asterisk on it mean? And it's C, where's the C? Okay, anyway. That is an I, okay? It's a little I. A little I, or sometimes they use a little R. But what's really funny is we always use cursive. Right? So with me, you can't tell what they are at all, because mine look kind of like that. Okay? That's like when I write depreciation down, a whole bunch of people, I write down depreciation like this. And what I get from students on tests is department. Because they just copied the notes and didn't know what I was talking about. So it's department. So please, nobody write out department for me, okay? It really hurts my feeling that my writing is that bad. Oh, well, fun though. Okay, so everybody got the idea? That's interest, okay, it's the interest rate. Okay, so I've got a present value, a future value, and so far, an interest rate. Okay, now let's think about interest. So I can calculate the value of something in the future. Let's say interest is 10%, and I wanted to calculate the future value. Oh, I need N too, don't I? What's that? Same N this one was. What is it? Number of periods, right? And let's make that 3 because we're going to make this really simple calculation for ourselves. Okay? It's not how complex the calculation is. It's intuitively understanding what you're doing. I don't care if the interest rate is 10.593428. Excel could care less, and neither could your calculator. Got it? How many of you do not have a calculator that calculates present values and future values? Do not have if you have a scientific calculator for your stat class or for a science class, obviously, right? Okay? Then it should do it. It's got a finance function in it. It'll do present values, future values for you. Present value of an annuity, future value of an annuity. If you don't know how to use your calculator, get online and look it up. You probably lost the little book that came with it, right? Everybody does. Okay, you can go online and look up your calculator, your model, and find out how to do it. Okay, make sure you know how to use it before you use it on a quiz or test, or you will give me ridiculous answers, and I will mark them wrong. Okay, or how many do not have a calculator like that? There's a couple of people in the other class. Those tables that are in the book, in the back of the book, in Appendix A, work just fine. What somebody did was they used the calculators to make the tables. I like the tables, not to use them, I never use them. I use Excel, of course, right? Because the tables are approximations, they're rounded. And Excel carries out a lot more decimal places. But these tables are really useful for seeing what's going on with present values and future values. Because it's hard to visualize. Exponential growth is something, you know what that is, right? Compound growth, exponential growth over time, is hard to visualize in your head, right? Same thing with, by the way, compounding is adding the interest. What's discounting? Taking the interest out, sucking the interest out. So we're going to do both. Okay, if I knew a future value, I could calculate the present value. By the way, if I know any 3 of these 4, I can calculate the other one. And on this quiz that we're going to do, when is it? Friday? You're going to be able to do that. Okay? You're going to have it made. Work these problems in the book. Okay? Be sure and work them. Okay, anyway. See you later. All right, guys. What is that interest rate composed of? Let's get this down first. That's I, okay? The interest rate, what's it composed of? Theoretically, what's it composed of? The interest rate that you pay. Does anybody in here have a credit card? You guys have your own, not your parents. If you have your parents, you don't know what the interest rate is of it, right? My daughter never knew, my son never knew, they didn't care. My problems, right? Okay. My son was never allowed to use it, but my daughter could whenever she wanted. He's still angry about these things. I told you about the cell phone, right? They were really expensive back then. She got one, he didn't. She's 4 years younger than him. He can go up to the door and knock at the door for crying out loud. He's a big guy. I didn't want her walking to anybody's door, so I spent money for her. So he still does. Yeah. So that's okay. We sent him to Japan for a band field trip. She got to go to a hospital instead. surgery, so that wasn't, yeah, that's kind of crummy. Yeah, her side of it. Okay, anyway, so things are not fair, are they? Yeah, okay, anyway, she's fine though, obviously, I guess. Okay, what is this interest rate composed of? Your credit cards. Interest rates, what do you have? Who's got their own credit card? What's your interest rate?
I don't know.
You always pay it and never pay any interest. Good for you. You'll find out if you don't pay. Yeah, always pay. I always pay the full amount. Anybody know what their interest rate is? Oh, for God's sakes. Nobody has their own credit card? Okay, you guys, if you went down to the bank right now, if we went to the bank and tried to borrow money, okay, how much would they charge you and how much would they charge me? For a credit card, if you can get them to give you one, you'll be around there, right? I don't know exactly how much my wife and mine are, but they're around here. We don't pay any interest either, right? Because I always pay. What's the difference between those two? I'm old and you're young and you discriminate against young people. Actually, they kind of do, because you guys are horrible risks. Oh, by the way, if he wants to get one and she wants to get one, he has to pay a higher rate than she does. You know why? Because guys are deadbeats and don't pay their bills. It's awful. Women, what do? They tend to pay more. Women get lower interest rates than men do. Yeah, when they're young. When you get older, it all balances out. Right? Guys get more responsible or something, I don't know. Okay, anyway, so what's the difference between these? Well, let's think about this. What is an interest rate composed of? You're going to learn in your finance class, and everybody's going to have one if they're a business major, right? Finance 315. True return, which is also called a real return or a nominal return, it's really the rent of the money, right? If there were no inflation and no risk, it'd be 2 to 3%. That's what you get for just renting your money. I know the bank doesn't give you that. They rip you off, okay? Don't put your money in a bank, except for a checking account. Put it in investments. Okay, but true return 2 to 3%. And then you add to that expected inflation. We don't know what real inflation is. We add expected inflation to it, right? So what the economic system does, okay? The economy does, okay? Banks do. Okay, expected inflation is probably right now around nothing, right? But we could say maybe it's 1 to 2%. Okay. By the way, you guys, you should get a credit card. You can even tell your parents I told you to do that. Get yourself a credit card. Whatever interest, I mean you, not them, right? Not them co-signing. You get one as soon as you can. And never use it. Well, no, use it. I take it back. Use it every month. Have a small balance on it every month and pay it. And you will improve your credit rating. First, you'll establish credit for yourself, and then you'll improve your credit rating. I did a really stupid thing. I graduated from college and I never borrowed any money, and I wanted to buy a house. And I went in and I had $10,000 down on a $40,000 house, which now would be like $25,000 on a $100,000 house, maybe, and probably more than that, right? But I had a lot of money, right? And I was going in. I was pretty young. I'd been out of school for a couple of years, and the guy looked at me and says, "I can't take your loan application to the board and ask them to approve it because you don't have a credit rating. You don't have credit." And I says, "I have $10,000 I'm putting down in a $40,000 house, and I make $20,000 a year. You think I can't make the payment? Really?" And, "Oh, I'm not worried about that. I'm really worried about the board." I'm not kidding. They did give me the loan. He had to work really hard to give me the loan. And he says, "For crying out loud, get yourself a credit card. Use it and pay it every month, and you will have great credit. And oh, by the way, pay your mortgage payment. And when you buy a car, for crying out loud, borrow the money. You're not going to have to pay hardly any interest. You have good credit now, right, with this loan. So, okay, get yourself a credit card. Go to the store and buy something with it that you really need. Don't just throw money away, right? And pay it every month. Is that what you're doing? Did somebody give you advice to do that?
My mom.
Your mom. Okay, good for her. Okay, yeah. Really? I'm not kidding. Our society is really strange. But don't leave a balance on your credit card because they're going to charge you 18%, which is 1.5% a month. And it's going to eat you up, right? Don't do that. Don't do that. And then what will happen is over time, your 18% will go down to 4%. We had a 21-year-old woman sitting in the class last hour who pays 5% on her credit card. I said, "Really?" I says, "It's your parents. They co-signed it." She says, "No, it's mine." "How long you had a credit card?" "I got one when I was a freshman in high school." She has great credit, right? Already at 21. So, and I said, "So have you ever paid interest on your credit card?" "Oh no, my parents would kill me if I did that." And so, no. All right, so guess what the rest is? This would be 3 to 5% maybe. That's real low risk people, huh? Pay 3 to 5. You know, like me and my wife, like that young woman class. Guess what the rest is? Risk. Oh, so what's your risk if you pay 18% interest? It's the same for businesses as individuals. What's your risk if you pay 18%? What does it have to be if this was, say, 4? This is 14%. Got the idea? A lot of risk. Okay? Everybody good? So what if a business is paying 10% interest on their debt? If this is around 4%, this is called risk-free, by the way, because there's no risk in it. You like that? It's just common sense. Risk-free. By the way, it's also RF. You like that? That's what risk-free is. Okay, anyway, it's risk-free. And add to that a risk premium, huh? RP. What would the risk premium be? You don't have to remember that for our purposes now, but it's just common sense, isn't it? Right? Let everything be common sense. Don't get blown away by it. Okay? What do we got? 6% here? A lot less risk in a company that's got 6% risk than 14. You got the idea? It's supposed to be the risk of not getting your money back because they go bankrupt or something, right? Or they're a deadbeat. They're young and irresponsible, right? Okay, got the idea? So that's it. Okay, so now let's give this stuff here a little bit of a shot, okay? Just a little bit. This is about how far I got in the other class, too. That rambled way too much. All right, so let's say I have a present value at time 0 of 100. I'd like to know the future value some number of periods from now, right? That's what I like to know. I've got an interest rate of 10%. And let's say our number of periods, let's make it years for now, is 3 years. You guys know how to calculate this. Just intuitively you do. You don't even need a formula. If I took my $100 and I invested it at 10%, how much would I want to have at the end of 1 year? My present value is 0, at time 0 is 100. And I want to earn 10% interest. How many of you want your money back? How many of you want your 100 back at the end of the year? Everybody. How many of you want 10% interest on it? So 10 bucks more. Everybody. I want 110 at the end of the year, right? So what we do is we take it times 1, get my money back, plus the interest rate. Got the idea? So we times 1.10. And what do I have, everybody? That's a future value 1 period from now. Got it? Interest for 1 period added would be how much? 110. Everybody see it? 100 will become 110. Now you leave it. You don't take it out. You're not taking the interest out, okay? So now how much do I have invested? 110. What if I leave it for another year? What do I want on that? I want my money back, plus I want the interest again, right? It's all that formula's doing, and that's going to give me a future value 2 periods from now. Make sense? So how much is that? What's 10% interest on 110? It's 11 bucks, isn't it? So how much would you have? 1.1 times 110 is $121, of course. Right? This is common sense. It doesn't matter what the interest rate is. It doesn't matter what the present value is. You could calculate it, couldn't you? Doesn't matter what the number of periods is. So the calculator's doing, it's what Excel's doing, right? It's what those tables will do for you. Let's go all the way. We wanted 3 years, so let's keep going. What would you take at times? 1 plus the interest rate, of course. Okay? And that's going to give me a future value 3 periods from now. What if it was 120 periods? Calculator doesn't care. Got it? Okay? 120 would be 10 years, 12 months a year, right? Okay? 360 is a 30-year mortgage, huh? Got the idea? 60 is 5 years making payments on a car, right? Okay, so this times 1.10. How much interest do you get that year? $12.10, and that's $133.10. Everybody agree with that? That's all there is to it. Now that was a waste of time. You think so? By the way we'd say this is the future value of $100 invested at 10% interest compound for 3 periods is how much? 133.10. That's the way you'd say it, everybody. Got the idea? That's what it is. Okay? This was a waste of time. What would be better? How about if we took $100 times what? 1.10 times 1.10 is what? 1.10 raised to the what, guys? Third. So what this is the present value at time 0 times 1 plus the interest rate raised to the number of periods. Big deal. Is the future value that number of periods from now. Guess what that's going to be? What's 1.10 raised to the third? 1.331. It is, isn't it? Times 100 is $133.10. And I want to, that's what your calculator will do too, okay? So let me show you one more thing. Take a look at the very end of your book at table A2. It's way at the end. See how many pages are left? It's way at the end. After chapter 14 or whatever it is. Chapter 13. Way at the end. Take a look at table A3. And go down to the 10% column. Then go down to 3 periods. What's the factor that's there? 1.3310. How'd they get that factor? They calculated it for you. They took 1.10 times 1.10 times 1.10, but I bet they didn't do that. I bet they took 1.10 raised to the third. Take table A2 at the end. Yeah, go back a little ways.
Okay.
Okay? And 10%, 3 periods. Okay? We'll pick up there next time. You see it?
Yeah.
Okay? See you guys. Work, work, work. This is really good stuff. Really valuable. It's going to pay off in your career.